All right, once again, you're welcome to today's webinar titled Qualifying Trading Opportunities. And like I was saying earlier, I particularly like this topic because it could make a big difference in our trading. One of the mistakes that some people make in trading is, not being able to or not consistently separating quality trades from low quality trades. And it's not because they don't want to do that. Sometimes we don't have a practical step to do that. Sometimes we don't even know how to do it. By separating quality trades from low quality trades and focusing on taking these quality trades alone, we can increase or improve our trading results by large margin. The idea is the market is always open, and that's something that we know. I mean, open 24 hours a day for 5 days a week, always open. And if it's always open, of course, prices are moving. There are over 1,200, maybe even 3,500 different instruments, really, that you can buy, sell, trade. You could trade currencies, multiple currencies across different nations of the world in pairs. You could trade commodities. You could trade energies, you could trade metals, you could trade stocks, you could trade ETFs, indices, and just the list goes on and on and on. And in every single time, every single instrument is moving at one point or the other. That means that if you look well enough, you would always find an opportunity to trade at every given moment in the market. As a matter of fact, you don't even need to look well enough. You would always find something. But does that mean that you should always take every trade idea that comes your way? As a business person, do you commit money to every business idea that somebody brings to you? Of course not. There must be a system for filtering what is worth your time and money and what is not worth your time and money. That you're not in the market does not mean you're missing something. And that's something that we need to come to terms with. Not a lot of traders are comfortable with not doing anything. That's literally the hardest part of trading, not doing anything. But the truth is, not doing anything is as important as even trading itself. As a matter of fact, it could even be more important in some cases. The act of sitting on your hands, not being in the market, patiently waiting till you see exactly what it is that you want to see and not just what looks like it. That in itself can make a massive change or improve your trading results massively. I like this comment from Alexander Elder, right? It's an interesting one for me, and I want to share with everybody here. Get up my screen stop. All right, here you go. Right. Very simple and straightforward and interesting, really. It says that the goal of a successful trader is to make the best trades. Really, your primary assignment, your primary job, what you're here to do. The reason why you're in the market is you're looking to make the best trades. You see, if you focus on that, money follows. Now, when we say the best trade, what are we calling the best trade, or what are we referring to as the best trade? A best trade, or what I'll call a best trade or a good trade, is a trade that has high probability of success, a high probability trade, and low risk. That's how I'm going to look at it. High probability trades and low risk. When you're talking about the best trade, your focus, your goal should be on looking for what we call high probability trades that have low risk. You see, if you focus on finding high probability trades, you'll be right most of the time. The challenge is a lot of traders focus on the money aspect and ignore this thing I just mentioned now, finding high probability trades. Now, if your focus is more on making money, really, just that's all you're paying attention to. I mean, with prices moving at every point in time in the market, you would feel like this is money, like you're missing out on the money you could just be packing, and you end up jumping in and out of different trades in a bid to make a profit. But the problem is you would end up mixing low quality trades and high quality trades, and then your result may not be as you would like them to be. I'll give you an example, right? Look at a scenario where two traders, one of them takes 10 trades a month. And these 10 trades, he just took them, he just kept taking them, he kept taking them. Of the 10 trades, really, only 5, or let's even say only 4 were actually high probability trades. Only 4. The rest, I mean, he got a nudge. He saw something that looked like what he would normally look for, and then he just went on to take it, and he took the 10 trades. Unfortunately, the 10 of the 4 trades that were high quality that he took, he made a profit, a good profit on 3 of them, and he lost money on 1. But of the remaining 6 trades that were not quality trades, he lost maybe 4 of them, and 2 basically maybe just break even, not ecstatic results. So in the total of the 10 trades, right, he made good profit on 3. He was more average, just a little profit on 2, and he lost about 5. Compared with the second trader, who in his own case focused on looking for these so-called high probability trades, and of the 4 that he found, just like the first guy, he only took those 4, and he made profit like we expect on 3, and he lost 1. So of the both of them, one took 4 trades, the other one took 10 trades. One made money on 3, the other one also made good money on the 3. But then if you look at their results eventually, the guy that took the fewer number of trades would have a far better result than the other guy. Because trading is not in the numbers. I always say that as a trader, your focus should not be on quantity. It's not about the number of trades that you take. Somebody sent me a question, I think yesterday or 2 days ago, and it was like he sent a screenshot of his trading platform. And on the platform, he had about, I can't remember the exact number, but the whole screenshot was filled with trades. So I'm saying 6 or 7, if not more, trades currently running on that particular account. And he was asking me and saying, is this the way to make money? I wasn't clear on the question. I asked and said, like, what does it mean? And he was like, oh, like taking plenty of trades. And I said, well, trading is not in quantity. It's not about how many trades you take. You could take 20 trades. If they're not good trades, you're not still going to have good results. And you could take 2 trades. If they're great trades, you could perform way better than the person that took 20 trades. So I think as traders, our major focus should be on the best trade. And if your idea is the best trade, and every time you pick your trading platform, every time you want to place a trade, every time you open your trading system, what is on your mind is there a good trade for me today? And if you do not find, then you stay out. That would be a good way to shift your trading results or position yourself for better trading results in the market. How do we find best trades, good trades, high probability trades, low risk? We're going to discuss that very shortly, but then it's important that you find. I said on the board, remember the idea is to trade well and not often. Another thing I also try to do is whenever we are out on seminars and events, we're talking to traders and meeting them in the multitudes, right? I always try to ask and say, what is your objective? In this case, we're saying, make the best trades. But if you think about it, The reason why you try to open an account, right, is you want to make money. That's the idea. I mean, making extra income seems like an attractive, you know, an attractive thing, right? And we want to make money, and we're choosing online trading as the means to that end. All right, fair enough. If the aim here is the objective here, the reason why you open the account in the first place is you want to make extra income. That means that it's not only about just taking trades. You must focus only on the types of trades that have a higher probability of making you extra income. That's what you need to do. You must focus on the types of trades that have a higher probability of making you extra income. Every second the market is open provides an opportunity to trade, yet not every second provides a high probability trade. And I said it here, I said a high probability trade is a technical trade that has a fundamental driver. We mentioned earlier that when we say your aim, your goal is to make the best trades, and I define the best trades as a high probability trade with low risk. Now, what exactly is this high probability trade? Simple. A high probability trade is a technical trade that is on the strategy side, on your chart, your strategy, your setup, right? You have it clear, just like you want it in your plan. But not just that, there is a fundamental driver behind it. There is a reason on the side of stories, on the side of drivers. There's something that is really in there, right? That is causing you to expect price to move a certain way. I'll give you an example. Let's assume I use a moving average strategy. And I always try to buy when the shorter term moving average crosses above the longer term moving average. That's when I try to buy. As a very simple example, right? That's all I do. And I prefer to make sure, just as a form of confidence, that this happens at an interesting, area on the chart. Maybe I focus on support and resistance, whatever the case is, right? Let's just say that's what I focus on. That's my technical setup. That's what I always look out for. A golden cross. When the shorter term moving average crosses above the longer term moving average. That's it. That's fine. I'm saying that for your trade to be high probability, it's not enough to find that part. That part is good, but it's not enough. You must make sure that there's a reason on the information side, a geopolitical reason, an economic data reason, a policy reason, a demand and supply reason, a global market theme, something, some factor that would make the price of that asset rise, that support upside movement, upside trajectory for that particular asset. If I don't have that to couple with my strategy, then I don't have a high probability trade. You have to make sure that for every trade that you take, there is a fundamental reason why price should be moving in that direction. It has to be. It takes the two sides to find good high probability trades. It's not only in the strategy, it's not only on the calendar, it comes together. I want to believe that you're following me and what we're saying is making sense. I want to believe that we're following and what we're saying is making sense. You're understanding what I'm saying. So what I'm saying in essence is your primary assignment as a trader is you want to make the best trade. And that is something that should ring in your mind at every given time. I mean, you could write it somewhere, you could paste it somewhere. Always remind yourself that your aim, what you're looking for is the best trade. And I'm describing the best trade as a high probability trade with low risk. High probability trade with low risk. And once we have that, how do we find high probability trade? I'm just saying now that a high probability trade is a technical trade where your setup is the way you want it, and then you have a fundamental reason why price should behave in that way. You should make sure that for every trade you take, there is a fundamental reason why price should be behaving in that way. You should not take trades just because you want to take trades. It's not just because I wake up in the morning, I like to trade Euro USD, I see a setup, I must buy. No, don't just trade for the sake of trading. Remember, your job really is you want to look to make money. So it's not just about taking all the kinds of trades you see. When you focus on finding high probability trade, right, it's not even enough because you see, finding the trade sometimes may not be difficult, but the problem is they don't come as often as some of us may want. That's the challenge. For some people, yes, they want to trade. We all want to place trades, but I mean, because we're expecting it to come in really fast, right? We want to trade. We feel like we want to make money. I mean, every moment is important. Every moment is crucial. We must be in the market. We must trade. Yes, we know we're looking for high probability trade, but the problem is it doesn't come as often as low quality trades. Sometimes you have to be patient. Sometimes you would have to be patient. In being patient, you could get bored. You could get the feeling that you're not doing anything. You could get that feeling. But the truth is, it's okay not to be in the market. You see, patiently waiting till you have the exact setup that you're looking for and focusing your energy on that type of trade and that one alone can do big things for your trading account balance. You see, if you allow the feeling of boredom or the feeling of unproductivity in that sense to make you take trades that you know don't fall into the category of high probability trade like we've explained, and you end up losing money on that trade, take it from me, is way more painful, right? It takes a bigger toll on your psychology when it comes to trading than when you lose a trade that meets all the criteria. It does. And this is why I say so. Think about it. Now, if you know you should not have taken this trade, but you eventually went ahead to take the trade and you lose money on the trade, the guilt, because you know you should not have, is something you knew. But in a case where everything adds up, this is what you're supposed to be taking based on your plans and everything, and you go ahead to take such a trade. If you lose money, the fault, you don't feel like the fault is yours. It's not you. The market just didn't agree with you on that day. So it's better. But when you feel like you should not be in the trade and you eventually go ahead to take the trade and you lose money, that feeling plays a lot into the next one you're about to take, because now the next one you start to second guess yourself. So the patience, the ability to wait, the ability to sit on your hands for half the time is very important. I have a few things here that can help us. I said, you know what? Let us list out a few things that can help us as traders to find these so-called, high probability trade. Now, you see, every trader, and I mean every single trader that is serious about trading, that looks to want to make good money out of the market, should have a plan. It's difficult to say you're doing things rightly if you don't have a definite way of doing it. There must be a guideline for your trades. I have a guideline for my trades. You should have a guideline for your trades. It does not necessarily have to be elaborate. It doesn't necessarily have to be too much. But it's just saying the unique way that you always step into the market whenever you're trading. Just the same way you have a routine when you wake up before you go to work. For some people, they must have a coffee. For some other people, they must have breakfast before they leave the house. For some, they can't eat till 12. But you notice, if you think about it, like, your routine is usually very, very similar. There's already a way that you get things done. As a matter of fact, in a business like trading, if you don't even know how you get things done, you cannot say clearly, this is exactly what I do before I click on buy or sell for any single trade consistently. How do you know which one is working and what is not working? You must. Because that way you can know, this is what I have been doing that is working, and this is what I need to adjust because it's not working. Oh, I made profit on this trade because I did this. But if you don't know what you did, it's difficult to replicate or repeat that same process. What is an example of what a plan should look like? See, a plan doesn't have to be difficult. It's just saying that, oh, how do you find the opportunities? I'm going to give you an example of mine, just a very rough, quick rundown of mine, so that you have an idea of what I'm referring to. Now, for example, when I wake up in the morning, I usually trade the European session mostly, right? When I'm looking at day trades or looking at sentiment-based trades. So I get up in the morning. I know the time I do that, right? Usually, for now, the session starts at 8 a.m. So by 6 a.m. typically is when I should get started. A lot of times when I'm up even before then, 5, I'm already on my device just running through the major headlines, finding out what's going on. But the idea is, before the trading session, I'm looking for opportunities. I'm finding what is going on in the market. I'm digging through different research platforms, finding out what happened in the Asian session, how it affects the market, how it affected the market, what is currently the major driver now, how it's affecting the markets now, and what are we looking forward to. How did what happened yesterday play out overnight? What is currently going on? I'm reading through research platforms, I'm scanning through, jotting the information I need to jot down, paying attention to what I need to pay attention to. That's what I'm doing. I'm conducting market research. I check the calendar for what's on schedule for the day. I check the currencies and the assets across board on the trading platform. I look at what gold is doing. I look at what oil is doing. I look at what the major currencies are doing, what equities are doing, what yields are doing. I want to know what's going on with all the assets. Is the movement in line with what I should expect based on the stories currently going on in the market? Is gold rising? If yes, why? What is going on with the pound? Oh, we had data early this morning for Japan. How has that impacted the Japanese yen? Did the Japanese yen react to it? Did it behave in line with that? Oh, yes, it behaved in line with that. The data was very good and the yen rose. Okay, good. This is the reason why the yen is going up. I'm doing all of these things, gathering my information. When I gather my information, I want to figure out, of everything I've seen, what is the overall sentiment? How is the market feeling today? Is the overall sentiment for the week still in play? Is there a new development, a shift? Once I figure that out, I say, oh, okay, based on X, Y, and Z, this is the sentiment, and these are the stories that are affecting the market. This is how each of these asset classes are reacting based on this. Fine. What do I want to do? Based on what I've seen, do I really want to trade or I don't want to trade? Based on what I have, is it something that I feel is worth my time, or I'd rather sit this one out? Oh, if yes, it's worth my time. All right, good. So these are the assets I want to trade. I want to buy this currency because of this. I want to sell this other one because of that. Equities are looking good as well. I want to get in on that. I have the ideas I want. I cross over to the chart. I open up the instrument. I move down to the time frame that I use for that type of trade, and then I deploy my strategy. I find opportunities to enter. If I deploy my strategy and I do not have an opportunity to enter yet, I know where I would enter because price is not there yet. So I wait. I set the pending order or I wait. Oh, I have a point where I could step into the market. Oh, well and good. I want to step into the market, but I also must look out for my exit point. At what point do I get out? If I enter now to buy this asset, where do I get out in profit? Where's my target? And if the trade does not go in my favor, where should I anchor my stop loss? These are the things that I do. And once I do that, I move on to the next step, which is my risk. How many percent of my balance am I looking to risk on this particular trade? At this point, I've not clicked on buy or sell yet, but I already know what I want to do. 1%, 0.5%, 2%, whatever the case is, I use that to determine the volume for that particular trade or the one I consistently use. And then after looking at all these things I've mentioned, I rank the idea. On a scale of 1 to 10, how confident do I feel about this trade? I rank the idea. How well, like, because it's not enough to say, oh, you want to buy. You must also figure out and say, yes, I want to buy this particular asset, this particular way. And when I have that, I figure out how confident. Based on everything I read, does it feel good? Is it something I want to be in? Or I'm not liking what I see? Yes, it looks good on the surface, but experience is not making me want to go in. Oh, the last time I had this particular trade idea, it didn't really turn out as well. Right? This part, I want to focus on. Once I'm able to do that, then I move ahead to take the trade. I hope this makes sense. It's not all about every time you see your signal, just buy. No, you must make sure that you walk your through it through the things I've just listed. Set up a plan. You to have a plan. Yours may not be like mine, but have a definite way. The reason why you want to even have a definite way of doing things is so that you can even know what's not working and you can make adjustments. So the day you send the chat to maybe me or any of your mentors or whoever it is that you're talking to, your trainees or anybody, you send a message to them and you're asking them, oh, something is going on with my trade. I'm not enjoying this particular part. This is not adding up. Whatever the case is, when you have that and they ask you, what have you been doing? You can clearly say, for the last 2 weeks, 3 weeks, 1 month, this is what I have been doing consistently. It's easier for us to review that and find out what the problem is than if you do not have a definite way of doing this. I said, set up a trading plan. Have a definite trigger. That is the things that you must see before you click on buy or sell. Now, if you're here and you do not have a plan at all, right? You over the time that you've been trading, you've not really taken time to like establish a definite way of doing things. definite way. And then decide on your risk. So the things I've just mentioned now, decide what risk, how much risk you want to take on that particular account. And this is another problem. You see, sometimes if we do not clearly determine the risk, right? If we don't clearly determine the risk and we just take the trades as they come, that also is a problem. It's also a problem. For me, I think it makes sense to risk the same thing every time. Risk the same every time. If you're always risking 1%, do that. So that when you have trades that do not work the way you expect, right? You're still on the same level. Just accept it takes an advanced level, maybe a good number of experience for you to start to adjust your risk according to how confident you feel about each trade, right? That could be, but at the very beginning level, keep your risk uniform. But of course, you're not going to stay at that level. You're all obviously going to have to grow as time goes by. But it's important that you decide on your risk before you're in the trade. And not just that, decide on your exit strategy. Are you going to jump out of the market if you see this? Are you going to allow the trade move if you have your stop loss in place? Are you going to close the trade after your stop loss? You need to decide on how you're going to get out of the market. If price is moving towards your target and it starts to range, but it's not at the target yet, will you close the trade? Will you wait patiently? You need to have decided that ahead of time, because if you don't decide ahead of time and you allow the trade to go, to move on, right? By the time it's time to close the trade or exit the trade, you're leaving yourself to a risk of allowing your emotions to interfere with your decision making. That's what you're doing. It is more likely for you to be making decisions emotionally when the trade is already run, because at that point now you're allowing room for fear, for panic, for greed. You're already allowing that to come into the game. Are we together? So determine your exit strategy ahead of time, and then you rank your idea. Right now, having spoken about that, I want to really touch on two more things before we move on. Right? You see, probabilities in trading have to be another important part of it. See, in trading, you've got to take your probabilities. You're not always going to be correct. And even when you're trading and you're trying to look out for the ones that are quality, the ones that are not quality, have it at the back of your mind that even when you find quality trades, you will not always be correct. I mean, the whole idea, the reason why we try to even do analysis in the first place is to increase the probability that we are correct. To make it more likely that price moves the way we expect. The probability that you're correct. But it does not eliminate the possibility that you can be wrong. And that is why when you trade, there is nothing like a never can fail trade. You must always, at the back of your mind, understand that you could be wrong. There are three possible outcomes for any given trade. You make money, you can lose money, or you can break even. So, yes, analysis, understanding what's going on, what you're doing, increases the probability that you're correct, but you must account for every of these possibilities and manage your risk at every given time. Your strategy, even though it's great, should work most of the time, but don't expect that it will work all the time. And the times that it does not work, you must make sure your risk is managed. But you wouldn't know the time it will not work. That's why for every single trade of yours, the risk management has to be there. You must manage your risk at all times. And I just put this last part, this last comment here because I felt like it will help you as a trader uh to maybe give yourself time. You see, time is a very key concept too as well in this trade. That your first two trades, three trades, four trades, using a particular strategy does not go up to plan. You don't make profit on them. Maybe you even lose money on them, right? It does not mean that strategy is bad. No, it doesn't. And you lose money in your first two trades of the day, or the week, or the month. Does not mean the strategy is bad, actually. Now, did I struggle to understand this early enough, early in my career? But the point is, if you think about it, no, it doesn't, because you're not going to correct all the time. What if those two times are the two times you're supposed to be wrong? But you see, if you get to the third or fourth time and you change it, you tweak it, then you could have some problems because now you're no longer following what you would have done. So that means that you don't even know what the problem is because you've not even done it up to 10 12 times. And your first two trades were good trades or were bad trades does not mean your strategy is bad. That you even made good money on your first two trades does not mean you know what you're doing yet or the strategy is great yet. You have to have a large sample size. Give yourself enough time to practice, practice, practice. Do the same thing consistently over a large number of trades. That is how you can know that over this number of trades, over time, I have seen that this particular strategy works best in this time or struggles in this time, works best with this particular instrument or this particular time of day, or it doesn't, struggles under these conditions in the market. But you need a large sample size to know. That's why you have to give yourself time. Consistency, using the same strategy, and then time. You have to. These little tips that I've given us have a way of sinking into our minds and would help us approach the markets differently. A plan is key. If you're going to determine what we call high probability trade, a plan is key. You must know what you're doing. You must be consistent doing it, and you must allow yourself to do it over time. And the things I've listed, not just the plan itself, the trigger, the entry trigger, not just the entry trigger, the exit levels and points and strategies, not just the exit levels and strategies, the risk. You must have all of this at the back. of your mind. You see, when you focus on this thing I mentioned, this phrase I mentioned, high probability trade, low risk, high probability trade, low risk, and high probability trade are simply trades that have fundamental drivers and technical setups, right? Your technical setup. Now, you may have a technical setup, a strategy that is different from mine, right? Understand yours and look for yours. Don't say because you feel like you're not getting your entry and you jump into use another strategy that you don't even understand how it works. Focus on yours, wait patiently. Now, you could be here, you probably are joining for the first time. You probably don't even know what a strategy is. You don't even have a strategy. You don't know what to do or how to build a plan. Remember, this is not the foundation course. This one specifically talks about a unique topic, right? At HFM, we have different series of training programs as well as even training classes like this. And what we have as a basic must have, right, beginning point is the foundation course. The foundation course allows us to lay the foundation, help everybody be on the same level as to the basic information that they need. With the foundation course, you get to learn how to build a strategy. You get to learn a strategy. You get to learn a plan, how to develop a plan, really, because I mean, the whole class is literally a plan. How to get started, the role of the broker, how to use the platform, how to manage your risk. These are the things that we deal with. And it usually runs on Mondays to Wednesdays, starting around 3 p.m. It usually runs on Mondays to Wednesdays, starting around 3 p.m. So the way you can get it is you could talk to your account managers. They could always give you the link to run through the classes, and then you can get started. That's if you have not gone through, you don't have an understanding of trading, you don't know what trading is about. You can start from there as well. I hope that makes sense. I want to believe that we have learned one or two things from this particular session that we have run through. But before we go, I'd like to take questions. I like to take questions. So please, if you have any questions, you can always send me a message, right, in the Q&A section, and I would attend to them, right? You can always send me a question and I will attend to them, right? If you have a question, please send it in the Q&A section and I would attend to them very quickly. All right, this one says very quickly, fundamental analysis and sentiment analysis alongside the technical analysis, if they are all in line, can we call that a high probability trade? Of course, we describe the high probability trade as a technical trade, that is, the technical side is in line, that has a fundamental, you could also add sentiment driver. So, of course, that's what we're trying to say. That when you have your two sides come together, that is, there is a reason why price should behave a certain way, and then you have your setup, your entry, your strategy in line, offering you an entry signal, then yeah, that's what we call a high probability trade. To make it the best trade available, you must manage your risk. And there you go. The basic training sessions, are they pre-recorded or live? We have a pre-recorded version on our YouTube handle, HFM Nigeria, but we also have it live every week, Monday to Wednesday. So it's usually live every week, Monday to Wednesday. So you can reach out to your account managers and you can get started with that. All right. Um, this one says, how can I find a good trade? I am a newbie in Forex. You're welcome, Mr. Chukuka. You're welcome. You're welcome. You're welcome. I already mentioned that you can get started. The best way to start is the foundation course. I think it lays the foundation as best as you need it for you to even start, and then we can branch out from there. I believe you have an account with HFM already, but if you don't, please go to our website, hfm.com, and sign up. Register. Your account manager is assigned to you, who reaches out to you to find out what you need, how we can help you, and how we can help you improve. Right. And then you can join the foundation class from there. Just request for the link to join the online foundation course, and then that will be done. And if you already have an account, then you already have an account manager. So please reach out to them, and then they would also, give you the link for you to join. All right. Is that okay? After at the end of this class, I'll also send the link to my training, to my chat. So you could also ask me a question directly if you feel like you want to ask a question on that. All right. Is there any pairs that you recommend for a beginner like me? Well, the currency pairs that you trade, really, I think it depends on the opportunities that you have available to you based on your system. And of course, you want to consider liquidity, you want to consider availability of information and the likes. Now, I don't have a particular pair I recommend because I trade the major currencies generally, right? So, major currency pairs, cross currency pairs, I trade them, right? Trades that involve major currencies like the dollar, the euro, the Japanese yen, the Swiss franc, the pound, the Canadian dollar, the New Zealand dollar, and the Australian dollar. I trade pairs around them. I do not really trade exotic pairs as much, but I trade the major currency pairs and the crosses, right? So, I mean, I think it's more of a function of the opportunities available to you. So, for example, if today I'm doing my analysis and the opportunity I have is on euro pound, that's what I'm going to trade. If on another day I'm also doing my analysis and the opportunity I have is on USJPY, that's what I'm going to trade. So I don't want to limit you to a particular currency or asset if I don't focus on only one. But you should also pay attention to, maybe you should start with the major currency pairs, right? And then you can move on from there. I see that we still have a lot of questions. I'll attend to them very quickly now, but I need to wrap this up in terms of the recording. So, just to wrap this up, I want to say a very big thank you to everybody for joining us in this particular session. Thank you, thank you, thank you.